In about a year from now, we'll have so much critical mineral and rare earths that you won't know what to do with them.
Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. President Trump signs a deal with Australia to boost America's access to rare earths and other key materials. The deal comes as the U.S. looks to reduce reliance on Chinese supplies. We speak live with Australian Treasurer Jim Chalmers about the economic benefits for Australia from that deal and why he rejects U.S. calls for Australia to decouple from China. Despite all the risks, stocks are still rising, but so are treasuries, with the 10-year yield dipping below 4%. However, Friday's U.S. inflation data is seen as the next risk that could jolt the market. Federated Hermes Fixed Income VP and Investment Director Karen Manna will be joining us to explain why stocks, bonds and gold are all rising together. Also on the show, we speak with the Hong Kong Exchange's Head of Equities Product Development on plans to expand derivatives trading in the city. Well, Asian shares extending gains helped by upbeat U.S. earnings and signs that tensions between Washington and Beijing were easing. However, the uncertainty around the trade war is still a top concern for investors. President Trump says rare earths, soybeans and fentanyl are Washington's main priorities in talks with China, as his administration braces for a fresh round of negotiations in Malaysia later this week. Trump also optimistic about prospects for a trade deal.
I expect we'll probably work out a very fair deal with President Xi of China. So most of you will be with us. It's going to be very exciting. And I think we're going to work out something that's good for both countries.
Well, aside from trade risks, investors are also keeping an eye on cracks in the credit market. Strategists at Bank of America say further signs of strain, risk provoking a broad equities rout. Meanwhile, markets are also bracing for key economic data. U.S. CPI numbers originally scheduled for last week have been delayed until Friday due to the government shutdown. The U.S. 10-year yield has dipped below 4% as falling oil prices ease concern about inflation ahead of the Friday release of that delayed consumer price data. Let's get market insights from Karen Manna, Fixed Income Vice President and Investment Director at Federated Hermes, which manages over $800 billion in assets. Karen, good to have you with us. It's not just 10-year yields. Yields pretty much across the curve have been at the lowest in months. How are you reading that? Is this a case of Treasuries back being a haven play? It shows that traditional, I guess, role that they play in uncertain times.
Thank you, Haslinda, and thank you for having me on the program again. And I think you're right on point. U.S. Treasuries at this point in time are exhibiting that safe haven tendency. But I think that we are all pricing in the expectations of a Federal Reserve that's on the move and balancing that against attractive growth in the equity market.
A Federal Reserve that's on the move. What kind of moves do you expect the Fed to make? I mean, the CPI data coming out on Friday will be key, won't it?
The CPI data will be key, but with that data delayed because of the ongoing government shutdown, it's 10 days overdue and will come at a time that's pretty close to when the Fed convenes next week. Also, this data collection could be somewhat marred again by this government shutdown. We're not sure how the data was collected toward the first half of the month, what prices will be used, will it be day by day? So the data collection, the overall data calculation leads us to be slightly less comfortable with this CPI print relative to others. In turn, month-over-month comparisons will be difficult and discordant because of the closure of the federal government. So as the Fed convenes, they will have this one additional data point on inflation, but they are without its counterpart, the non-farm payroll report and the unemployment report that were to be released the first Friday of October. So it's a Federal Reserve that stands without much new information and without a significant shift or change in trend from what they knew from the last meeting. So this causes us to believe that they will stick with what they said that they were doing. And we didn't really hear anything different from Chair Powell at his presentation last week. So it seems reasonable that the Fed will ease again by 25 basis points. And it is also likely that they continue that path at their December 10th meeting as well.
So, Karen, even if the data is late, if there is an upside surprise, that could play out in the markets in a big way. Do you agree?
Oh, for sure. You present a very compelling and interesting case. It is true, if there was a spike in inflation, it would definitely give the markets pause, and it would make the Federal Reserve and the open market committees move less assured and less backed by the data. However, one data point does not indicate a new trend. And again, the data collection and calculation of this CPI print in particular will be questioned. So yes, that will give the market pause, and it could actually and perversely shift the dynamic or what we're thinking about with equities, because what it might do is shift the pattern in what the markets are thinking for 2026. If the Fed continues with a minor repair to their policy rate and moving down closer to what they think is neutral, which I'm in the camp that that's a range rather than a definitive point, and of course depends on the macroeconomic circumstance. But if the market needs to price out a number of eases for 26 because inflation is peaking while equities continue to be very, very strong, then that leads it to be difficult to believe that we'll have as many eases. Equity could question that and ultimately reprice toward a higher neutral point for Fed funds.
So 2026 will be a bit more complicated, but for 2025, for the rest of the year, what is your base case? We know that the next move is likely to be at 25, but some say 50 is not off the table, depending on what's coming up in terms of data.
I think that 50 I would characterize as wishful equity thinking. It seems that the Fed here, thank you, the Fed here is aligned with 25 basis points in easing, which is their standard and matter, of course. Now, they did surprise us a year ago, September, and started off with a bang. They did give 50 basis points and then two subsequent shifts of 25 before pausing again and waiting until September of this year. But I think that they will stay on that straight and normal course of 225 basis point eases for the balance of the year. And that causes us to focus on a fixed income curve where the 2-year through 5-year likely react in accord with the Federal Reserve, but the 10-year and longer most definitely price in inflation, risks, debt and deficits, and a whole host of other issues that I think will ultimately prompt the 10-year to rise above 4% and perhaps crest even a little bit higher.
And you know what? We're not short of risks, right, Karen? I mean, we have the regional banks now raising yet the risk of bank stress. How are you assessing that risk, and how are you positioning on the back of that?
At Federated Hermes, we really are a credit shop at the very core and heart of our very being. Our days begin with individual credit committees that are focused on high yield, investment grade, asset backs, municipal securities, government securities, and that is the core of our underlying process. So for us, rooting out different types of credit stress is part and parcel with what we do every day. So while the market is characterizing these known events, the bankruptcy filings of First Brands, Tricolor, and then the regional bank disclosures that came to light late last week as idiosyncratic, we do see it as a small sign that some have been chasing yield, perhaps without dotting the I's and crossing the T's. And I know that that sounds trite, but credit work is very, very stable work and also rests on surveillance of the underlying credits. So knowing where the collateral is posted, knowing the underlying business, for us is day to day, and it's the first step. We did not have exposure to First Brands. We did not have exposure to Tricolor. And they were names that crossed our desks, but frankly, the portfolio managers and analysts did not opt to invest or even really take a very deep dive into those names because of simply their businesses. So passing off all of these instances, while small, while perhaps idiosyncratic, while perhaps they have elements of fraud, we think do speak to broader credit strains among the credit process, more so than a rampant risk or a step toward contagion in the credit markets.
We're looking at 10-year yields right now below 4%. How much lower do you think 10-year yields can go? Some say perhaps if you see additional stress in the credit market, it definitely has a lot of room to go lower.
Of course, if you saw extreme credit stress that led to recessionary tendencies, the 10-year could go lower. But I think that the 10-year moving lower right now is a function of the geopolitical tensions, the ramp up in trade talks as we approach November 1st and that all-important meeting, and then also how Treasury yields do tend to fall when our government is shut down. I think when we clear those hurdles, when the government reopens, when we get renewed data resources, when we pass this important meeting with China on November 1st, that Treasury yields will once again incorporate many of the factors that we are accustomed to, and we actually could see the 10-year rise modestly into year end.
The thing is, Morgan Stanley weighed in on it. You know, they were saying that you should just say goodbye to 10-year yields above 4% because of the increasing number of risks out there. What is it, I guess, miscalculating if you do see 10-year yields above 4?
Well, if you think about all the risks in this world and these little quarters of idiosyncratic credit risks that have appeared, that's one factor. But we also have debt and deficits that are increasing in this country. And we have inflation, as you and I have talked about, that is approaching 3%. Now, the Federal Reserve believes that over a 2-year period that it can gradually and slowly approach 2% again. And inflation that, again, is closer to 3% with rising debt and deficits and our government in discord seems to me to factor in a yield on the 10-year above 4%, more so than it does a yield that continues to fall below 4%.
Karen, right now, there's a lot of optimism. We're seeing in everything rally. Stocks, bonds, gold. Look at gold. Is it all making sense to you?
It is very, very different. It's not a textbook situation of how economies and markets typically work. But I think it's very much a function of all of the liquidity in the market. We do have AI, a boom. It's CapEx spending, and it's rather different than the tech bubble that formed over the dot-com era. The companies that are financing this AI growth have solid balance sheets and revenue and earnings. But akin to that, because of all of the liquidity, while many want to participate in that upmarket equity rally, I think they are taking opportunity in gold in order to hedge some of that growth through real assets.
So in terms of the sustainability of this trend, how long might this last, Karen?
Well, isn't that the million or billion or trillion dollar question at this point? It does seem to have legs into the end of the year. When we were approaching the fall back to school season here in the U.S., we assessed equity market conditions, and it was our team's view that we might see a pullback. Similarly, in credit, we thought we might see some disruption in credit spreads, and both teams equity and fixed income thought that would be a buying opportunity going into year end. I think that we would need to see an extraordinary disruption, either from geopolitical and trade, either a disruption in earnings from the hyperscalers that will emerge next week if their forecasts aren't up to snuff with the market. Other than that, I think that we could continue to rally, take some pauses here and there, but end up with a pretty strong position going into year end.
Karen, great insights as always. Karen Manna of Federated Hermes there with us. Still ahead this hour, Amazon's cloud services outage crashed hundreds of online services globally, highlighting just how much the internet is dependent on a single company. We'll have the details next. Keep it here with us. This is Bloomberg. Welcome back to Insight. Amazon Web Services, the world's largest cloud provider, says it's back online after a massive outage that knocked out thousands of websites and services worldwide. Experts warn the financial fallout could reach billions of dollars and underscore just how concentrated the internet's backbone really is. For more, let's bring in Bloomberg Tech reporter Newly Parnell. Newly, give us the very latest. I mean, we know this is a massive outage. I mean, who would have thought that the internet could go down? Where are we with recovery?
Yeah. You're right, Haslinda. It really was massive. It was, you saw these outages for something like 15 hours. And what's really amazing is to look at the variety of the hundreds of services and websites that were affected. So everything from communication services like Zoom to financial services like Robinhood, Venmo, some of Apple's services, and even Amazon's own services weren't immune. Alexa and Ring were hit. Now, what Amazon says happened is that a database had an issue and they thought they had resolved it. They went back and checked and it was still causing some issues. So really huge variety of services over a pretty long period of time, Haslinda.
What's the big picture here? Does the outage point to any larger issues?
I think two issues really come to mind. First is you mentioned the sort of prevalence of AWS in this underpinning of the internet, the sort of like plumbing of the internet. They have about 30% of the market for global services, compute, that sort of thing. It just points to how prevalent they are in running a lot of this infrastructure of the internet. The other thing I would say it points to is really how interconnected all of these services are. You might think back to last year, the huge CrowdStrike problem, the cybersecurity provider that brought down airports and grounded planes along the world and around the world and had huge economic impact. I think this is a reminder that AWS is a really big player in the market, and it's a reminder that this undergirding of the internet is just really prevalent. When you open an app or place an order or visit a website or try to log in, do these things that you think are the service, the surface of these services, really AWS and other cloud services like it are underpinning it, and when they go down, there are really big repercussions.
So it comes down to too few providers. There's a need for diversification in cloud computing. I'm just wondering, where are we with that? I mean, what are the options? What's being done to address the issue?
Right. Well, I'm sure Amazon probably more will come out in the coming days and weeks, perhaps technically about what went wrong, and I'm sure they'll be seeking to fix that so it doesn't happen again. It's probably also some of the enterprises that they serve will want to make sure that they are drawing on, diverse sets of suppliers, and perhaps they're not as reliant on any one. But I think these things are really hard to avoid. Amazon and AWS will do their best, of course, to try to fix it technically, and I bet some of their clients will just think about what are their redundancies, are they taking steps to make sure that they have backup systems in place so something like this doesn't happen again.
Newly? Thank you so much for that, Bloomberg Tech reporter Newly Pernell there, coming to us from Hong Kong. Now, the widespread Amazon Web Services outages are also highlighting the importance of managing cybersecurity, including customer identification. That's according to user management software company Okta, whose CEO Todd McKinnon told us more about those growing challenges.
I think about the world as layered into different critical services. Cloud infrastructure is one critical service. And as the leading independent neutral identity company, we're building this identity service for the entire world, whether that's enterprises, whether that's consumers, whether that's people building AI agents. We want to be that identity infrastructure. It's important for cybersecurity, it's important for business continuity, and it has to be reliable.
So how do you make sure that it's reliable then?
A lot of redundancy and a lot of focus and a lot of making sure we do exactly what customers expect, whether it's backups, redundancy, and monitoring it continuously. It's very important for us.
Now, you are growing very, very substantially. What, you have 800 people in San Francisco, and how many thousand around the world?
6,000 global employees doing a great job for our customers every day.
Well, love to hear it, and I hope they are. How fast are you adding customers, and what's your pitch versus another identity security company?
Yeah, it's an interesting perspective we have, and there's different perspectives on. Some vendors want to sell you everything across the entire application and platform stack. Some vendors want to sell you everything across cybersecurity. We focus on identity, and we focus on verifying who the people are in your company, who the people are coming to your website as customers or prospects. And now, really, with AI agents, we make sure that that identity service is continuous across everything you're trying to automate in your business with AI, too. And that's our focus. And beyond that, we focus on connecting to everything else in the technology stack and letting our customers choose what they want to use.
What is the scale of AI agents Okta expects in the next 12 months?
It's starting out very strong, but it's going to be growing significantly. When you think about what companies can automate with these AI agents, how they can improve their top-line revenue, how they can cut costs, how they can be more efficient, how they can serve their customers better, it's got tremendous potential.
What about your exposure to ChatGPT user growth? How much of that do you have, and how is it changing how you do business?
Well, I think ChatGPT is the perfect example of how much can be automated with AI. And when every company looks at that, they think, hey, we can make our customer experience better with adding ChatGPT-like capabilities. We can make our employees more productive. So it's really driving them to deploy more AI technology. And that means more identity is required. Those connections have to be secure. Those connections have to be reliable. So it's really an exciting time for the industry.
And that was Okta CEO Todd McKinnon speaking with our very own Vonnie Quinn. Let's take a look at how Asian benchmarks are doing right now. We know that they're joining that rally, the global stock rally. The MSCI HKEX index currently up by 0.9%. Lots of optimism in the market on the back of easing trade concerns, also expectations of the Fed cutting rates further. The Hang Seng being lifted by tech stocks in particular, currently leading the pack, high about almost 2% right now. The Kospi up by about 1%. And this is how it's looking, shaping up for the U.S. markets. U.S. futures looking like this. Of course, front and center would be the CPI print expected at the end of the week. The S&P futures pointing to a higher open, up by about 0.1%. Now, still to come on the show, a deep dive into the outlook for Hong Kong's growing ETF market with Hong Kong Exchange's Brian Roberts. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. The Hang Seng Index extending its lead, currently up by almost 2%. Of course, this is one stock market that's been And that's been an outperformer in the world on the back of the very hot IPO market. Also, the return of investment appetite in the market as well. In terms of HS Tech, currently up by almost 3%. It is contributing in a big way to the gains that we're seeing on the Hang Seng. Well, our next guest oversees the development and management of equities products at Hong Kong exchanges and clearing. Let's discuss the outlook for Hong Kong's capital markets with Brian Roberts, Head of Equities Product Development at HKEX. Brian, good to have you with us. We've been talking about how well the Hong Kong market has done. There's been a lot of interest in the market, especially in China. How is the Hong Kong exchange positioning itself in terms of product development to better capitalize on this interest?
Yeah, I mean, there's been a lot of momentum building into the market. And as you mentioned, over the past 12 months, the Hong Kong market has really had significant performance here. The one thing that we focus on is really about building liquidity flywheels. And this is really about how do we attract more companies to list here in Hong Kong. Second, how do we create the product ecosystem around that? That's ETFs, derivatives, single stock options, and then also improving the accessibility and the efficiencies of our market. And I think when you put all of these things together, you also get some tailwinds going with you as well. You really start to see a tremendous amount of liquidity growth. And we've seen that both in our cash equity market and also in our derivatives market this year, all reaching all-time highs. So we'll continue to kind of focus on those kind of areas, try to innovate in products, attract more and more companies. This is what keeps the market interesting and keeps driving our markets forward.
There's been a lot of discussion about retail investors. Any effort, any plans to introduce more retail-focused products?
Yeah, this is a big focus for us in trying to drive retail participation in our markets. And I would probably look over in a couple of areas of what we've been doing to increase retail participation. I think number one, in the ETF market, covered call ETFs have been a tremendous success for us over the past 12 months. We're starting to see more and more of these products here. Retail investors are very attracted to these products, one for their yield or their enhanced income or yield that they produce, but also giving growth potential as well. As a matter of fact, we have probably the fastest growing cover call ETF here listed in HKEX. And again, we're continuing to see more innovation there. The other innovation that we've seen in the Hong Kong ETF market is the introduction of single stock levered and inverse products. We started with those early this year. It's giving investors, both retail and institutional investors, the ability to access global stocks here on HKEX. The last thing I'll just kind of mention is back on our derivatives market. We're seeing more and more participation from retail investors, and specifically within our stock options. We introduced weekly stock options last year in November. We're coming up on the 1-year anniversary, and now weekly stock options account for about 15% of our single stock option market this year.
How about 0 day to expiry? The plan is to introduce that in the first half of next year. Is that still on track? What's the thinking, if you can be more definitive on when that might happen?
Yeah, this is a plan for us is to continue to follow this short-dated megatrend in our options market. We've had tremendous amount of success both on our weekly index options and weekly stock options. So this is part of our plan is to bring out daily index options. We're going through, we have to go through the regulatory approval process. We also have to prepare our systems as well for this. And then lastly, just make sure the ecosystem is ready for these products. So we are targeting next year, but right now it's just too soon to say when specifically they will come out.
Some say that this is a super speculative product. It could cause a lot of volatility. What's the thinking on that?
Yeah. We see these products elsewhere in the world. I don't think there's really conclusive evidence that these are adding volatility into these products. We actually find that a lot of investors, both institutional and retail, are using these products. They do it for a few different reasons. They're trying to hedge any kind of event-driven risk that's happening in short term. They also have shorter or less option premium compared to the longer dated options. So For us, I mean, we're going to continue to kind of innovate in our products, try to bring products out that matches investor demand for both a diverse ecosystem of institution and retail investors.
Brian, thank you so much for that. Brian Roberts, Head of Equities Product Development at HKEX. Now, shares of rare earth companies are surging in Sydney after President Trump signed an agreement with Australian Prime Minister Anthony Albanese to boost U.S. access to the critical minerals. The deal outlines $8.5 billion worth of projects, with both nations initially committing $1 billion over the next 6 months. Australia holds the world's fourth largest deposits of rare earths and has sought to position itself as a viable alternative to China for critical mineral supply.
In about a year from now, we'll have so much critical mineral and rare earths that you won't know what to do with them.
For more on that critical minerals deal and what it means for the Australian economy, let's bring in Treasurer Jim Chalmers. He joins us from the APEC Finance Ministers meeting in Incheon, South Korea. Treasurer, good to have you with us. Good to see you again. First of all, were you given any assurances that perhaps this won't just be America first?
Well, it's nice to talk to you again, Haslinda. All the best to you from Incheon in South Korea. Prime Minister Albanese had an outstanding meeting with President Trump today. We're very, very pleased with how the meeting went, and the critical minerals framework is really one of the most important bits of progress that we saw in those discussions. And what that's all about is about helping to ensure Australia becomes a world leader in the export of rare earths and critical minerals. It's all about making sure that we strengthen our trade ties with the US, that we strengthen supply chains, and that we make sure that this remarkable opportunity that Australia has with rare earths and critical minerals is properly maximised.
So who will decide which projects are viable? Is the government choosing the winners here?
Well, this industry already, we think there are about $13 billion Australian of projects in the pipeline. A really extraordinary opportunity for Australia, a golden opportunity. And what the American administration and the Australian government have agreed is that each of us will invest $1 billion over the next 6 months, as you rightly said in your introduction, in some of these really important projects. We believe Australia can be and will be a world leader in the supply of rare earths and critical minerals. The agreement and the framework that was agreed with President Trump today is an important part of that effort. It's a golden opportunity for Australia, and we intend to maximise it.
The thing is, there is reason to think that could be competition between an American and Australian company. I'm just wondering, how will it be decided when it comes to that? For instance, if you have liners and MP materials at odds, how will you decide?
Well, it's not beyond us for the commercial arrangements to reflect the scale of this opportunity and our obligations to each other under this framework. Obviously, rare earths and critical minerals have a number of important applications, including in defence and technology, and in the industries that the US administration are very keen to work closely with Australia on. We intend to be a reliable supplier around the world, but this agreement with the US is about strengthening trade ties with the Trump administration and the US more broadly. It's about making sure that those supply chains are robust and reliable. We will have markets all around the world for these critical minerals, and that's a good thing. But the American relationship is very important to us, and today we strengthened it.
When you think about these rare earth deal and the projects which are coming up, we know that Gina Reinhardt, for instance, has a finger in a lot of these pies, and some are raising the concern that perhaps, taxpayers' money would end up at one end of town, which is the richer end of town. I mean, how do you respond to such concerns?
This critical minerals opportunity for Australia is a big opportunity for our workers, our local communities, for our businesses and our investors. And there's more than one investor or owner of critical minerals resources in Australia. But whether it's mining, refining, adding value, processing, working with our international partners, We shouldn't see this as anything other than a massive opportunity for Australia. It's why we put so much effort into engaging, whether it be with the US administration, whether it be here in APEC with the 21 economies of our region. We recognise that Australia's got a lot to offer the world. We've got important relationships right around the region, and we intend to supply other economies with our critical minerals and rare earths in a way where the benefits in Australia are broadly shared, including amongst our world-leading mining workforce.
Do you think China overplayed its hand in imposing the curbs on rare earth supplies?
I wouldn't engage in that sort of commentary. We engage with the Chinese administration in good faith and in Australia's national interest. We engage with all of our trading partners in that fashion. I'll leave the analysis to others. Our interest here is making sure that we continue to be a reliable supplier, that we play an important role in strengthening supply chains in this industry, whether it's in the United States or elsewhere. But our relationship with China is important to us in economic terms as well. We've put a lot of effort into stabilising that relationship. The Chinese economy is not without its fair share of challenges, but we are confident that it will continue to be an important source of growth in our own economy in Australia. And we believe it's possible to engage with the Americans in the way that we have been and to continue to stabilise and invest in that very important China relationship at the same time.
Treasurer, so it all sounds good for the Australian economy. Let's take a look at your budget. What are the prospects of a narrowing of your budget deficit, given that, you know, the commodity space is doing really well? Take a look at where gold is. In terms of tax receipts from miners, that should be looking pretty good as well. How is that deficit looking for you?
Well, in our first term of government, in our first 3 years in office, we engineered the biggest positive turnaround in our budget in a single parliamentary term in Australian history in nominal terms. We delivered 2 surpluses, and in the most recent year, the deficit was around a fifth of what we inherited from our predecessors. And so we've made good progress on the budget, but we know that there is more work to do. A big reason for that progress has been the strength of our labour market. But also we found $100 billion in savings. We've shown spending restraint. We've banked most of the upward revisions to revenue, which comes from a stronger labour market and relatively strong commodity prices. And so that has improved the budget, but we know that there is more work to do. And when you spend time in these international forums, as I have been, in North America last week and in Asia this week, it becomes very clear that Australia's budget is in much better nick, much better condition than a lot of other budgets around the world. In fact, the gross debt for the year just finished is $188 billion lower than was projected just 3 years ago. So we've made good progress. We know there's more work to do to make our budget more sustainable, but because of the progress we've made, we've got the debt down and we've got the debt interest down as well, and that's been important.
Is there a potential for a surplus, Treasurer?
We're not forecasting that for the coming fiscal year. There are pressures on the budget which are frankly intensifying rather than easing, including in the care economy and elsewhere. But we will continue to manage the budget in the most responsible way that we can. We will build on the very substantial progress that we have made already to continue to ensure that our budget is as sustainable as it can be in the face of all of this global economic uncertainty and in the face of the spending pressures which are familiar to a lot of the economies that we're engaging with here in Incheon.
Treasurer Chalmers, all eyes on monetary policy as well. The market's pricing in 2 more rate cuts. In your opinion, is that enough for the Australian economy?
Well, there are good reasons why Australian treasurers don't engage in commentary about the future movement of interest rates. We don't predict or preempt decisions taken independently by our Reserve Bank board. Interest rates have already been cut 3 times in Australia in the space of the last 7 or 8 months or so. The market is expecting further interest rate cuts before long. My job is to focus on the economic fundamentals, which are strong in Australia. We are genuinely an island of opportunity and resilience and reliability in a sea of global economic uncertainty and risk, so as to continue to tend to the macroeconomic fundamentals of our economy, the strong labour market, the fact that we've got inflation down considerably. That's my focus. I'll leave decisions on monetary policy to our independent Reserve Bank.
So when you take a look at the economic fundamentals in Australia, are you perhaps frustrated by the gradual pace? Because when you take a look at what other central banks around the world have been doing, they've been more aggressive in terms of the rate cuts to help the economy grow faster.
Well, obviously, when interest rates are cut, that has a positive impact on the economy. I think that's self-evident. That's Economics 101. And because of the progress we've made in our economy, particularly on inflation, but we've been able to get that progress on inflation without paying for it with substantially higher unemployment. We've got real incomes growing again. So there's a lot to be proud of in the Australian economy, and that has given the Reserve Bank the confidence to cut interest rates 3 times already this year. Again, I'm not going to engage in anything that goes beyond that, or which could be misread as encouraging the independent Reserve Bank one way or the other. But I think certainly any objective observer of our economy over the last 12 or 18 months would recognise we've continued to see it grow. We've managed to get real incomes growing again. We've managed to keep the labour market relatively strong, certainly by historical standards. We've managed to get inflation down very considerably from its peak a couple of years ago. And when the Reserve Bank meets to take these decisions independently, they will weigh all of that up.
And Treasurer, speaking of the economy, you have to talk about China, which is your largest trading partner. I guess economic recovery is pretty sluggish, and it's been trying to reverse that. How are you factoring that into your own projections on growth going forward?
Well, obviously, Australia's got a lot of skin in the game when it comes to prospects for the Chinese economy. As I said a moment ago, there are no shortage of challenges in the Chinese economy, in its property sector and in other important respects. But we're very confident that China's growth will continue to be an important source of Australia's economic success. We have put a lot of effort into stabilising that relationship, maximising that opportunity, given China is such a big and important trading partner of ours. Like the rest of the world, we will watch closely the developments around the new 5-year plan when that's announced before long. But as I said, China will continue to be a really important part of Australia's economic prospects. It warrants and receives a lot of our attention. And that will be especially the case as we see the developments around the 5-year plan. And when it comes to our forecasts, we'll update them in the usual way in the budget update towards the end of the year.
Treasurer Chalmers, always great to have you on the show. Thank you so much for your time today. Australian Treasurer Jim Chalmers there. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back to Insight. Global bond traders from New York to Singapore have been lured and burned by a trade known in Japan as the Widowmaker. Senior FX and rate reporter Ruth Carson joins us with more. I mean, what a name, one. And two, what is this Widowmaker trade?
Well, it's called the Widowmaker for a really good reason. For a couple of past decades, we've seen traders getting absolutely burnt by betting against Japanese bonds. So a lot of traders have placed bets that, you know what, yields are going to go up. And as we know, for the last couple of decades, it's been very much a losing bet. But this time appears to be different. So we did our own analysis, looked into the data, and Japanese bonds on aggregate have lost 4% this year. Now, That's the worst performer across 40-odd markets. And just to give you a perspective on things, the second worst performer was actually down less than 1%. So by far, the Widowmaker is indeed turning into a rainmaker for quite a lot of people.
The thing is, what's different this time? I mean, we talk about it being a Widowmaker trade. What's different this time? Why are they making money from it?
I suppose if I was to sum it up in one word, it would be inflation. We've seen inflation being above the BOJ's target now for a couple of years. And the BOJ, even though many people say it is glacial with the rate hikes, they are still hiking rates. Rates have gone up. So when you've got that, along with a cocktail of trade angst around the world, you've got the issue of Japanese politics as well and prospects of more fiscal spending. All of this is negative for bonds. So for the Widowmaker trade, perhaps it's less so now and definitely more profitable for the short sellers out there.
Is there more juice, or am I too late?
You know what? That's a perfectly great question to ask, and I think we'll all be billionaires if we manage to answer the questions. Well, definitely more juice in the trade. People are indeed saying if there is one bond market to short, look at Japan. We've seen treasuries getting bid. I mean, France has its own problems, as we are all aware, but a lot of the other markets, it's a bond rally mode, right, for everyone. Japan is the one exception to the rule, and remember, they're an anchor to global rates around the world. So watch this space, but people are definitely saying, you know what? Push the pedal on this.
What would be the risk be? I mean, we know that when you put in a trade, there's always that risk that things could go wrong.
Absolutely. It wouldn't be a market otherwise, isn't it? So the key risk to these trades, there are actually a few of them. First of all, if inflation does fall. If, for example, trade angst and the trade war as we know it today takes a turn and growth actually tanks in Japan, oh my, just watch it. You know, JGBs would definitely be bid then. There could be others as well. So, for example, if markets are wrong about expectations of fiscal spending. So these are the key traits, the risks to this trade.
All right, Ruth, thank you so much for that. Senior FX and rate reporter Ruth Carson there with a Widowmaker trade. Now to some top global stories we are tracking. The U.S. is weighing tariffs of up to 100% on all imports from Nicaragua. The U.S. Trade Office says Nicaragua's labor and human rights abuses, along with the dismantling of the rule of law, amount to a burden on U.S. commerce. The universal tariff, which could be applied at a lower rate, is one of 4 actions the U.S. may take in response. And President Trump says the U.S. will destroy Hamas if the militant group fails to honor the ceasefire with Israel. Trump says this doesn't mean he would send American troops into Gaza and that he would ask Israel to take care of it. The president's comments come after a series of alleged Hamas ambushes and Israeli airstrikes, with each side accusing the other of breaching the peace agreement. A U.S. appeals court is allowing for now Trump's plan to send troops to Portland to counter protests against his immigration crackdown. A divided court in San Francisco lifted the order, blocking deployment of 200 Oregon National Guard members to the liberal leading city. Trump has claimed without evidence that Portland is burning to the ground and being overrun by insurrectionists. And before we go, here's a look at our guests for tomorrow. We'll get market insights from SEB's head of Asia strategy and BNP Paribas global head of sustainability. That's ahead of this week's rate decisions from South Korea and Indonesia. And that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.